So, hello everyone. I want to thank you for keeping it with us on NB Consults TV, where we discuss financial issues, but also accounting concepts, as well as international financial reporting standards and international accounting standards. So, today we want to look at the IFRS 16, accounting for leases. Accounting for leases or leasing. So this standard was formerly IS 17 and it is IFRS 16 that superseded it. So now we shall start by understanding what a lease is. And a lease is a contract that creates the right to use an asset for a period of time, but in exchange for consideration. So meaning the lease or the contract creates two parties. One is the lessee and the other party is the lessor. The lessor is the legal owner of the asset, but the lessee is the party that is interested in using the asset, but in exchange for consideration. There are two aspects that we need to note before we go into the practical application of the standard. One being the asset must be specifically identified. So now that the asset under the lease or for leasing purposes must be identified by both parties. Two, that the lease must also show the right to control the use of that identified asset for a period of time. So those terms must be really looked at by both the parties. Now, we are going to focus specifically on the books or on what happens in the books of the lessee. What happens if the lessee agrees to take an asset on a lease agreement to be used for a specific period of time, but in exchange for consideration or a payment? What happens, or what does the accountant or the lessee do in his books of accounts? The standard or the IFRS 16 requires the lessee to initially recognize the lease liability by discounting the minimum lease payments using the discounting rate implicit in the lease or the lessee's incremental borrowing rate. So initially, because the lessee is going to take an asset for more than a year, meaning since he's not going to pay or to purchase, then it means that there is a liability that is payable over the lease period. Two, the standard also requires the lessee to recognize the right of use asset. In this case, the lessee is not having the asset itself. The lessee cannot ascertain the cost of the asset. But what he has is the right to use the asset for a certain period of time. But of course, in exchange for consideration. So now, how do we get the lease liability? Or how do we get the right of use asset? For the lease liability, I have talked about it. You discount, you get the present value of the minimum lease payments by discounting using the interest rate implicit in the lease. But to get the right of use asset on initial recognition, you get it by getting the lease liability you add back the initial deposit, then you add back direct and indirect costs, then you add back decommissioning costs. Then after you press release incentives. So now by doing that, you get the release liability. Now, excuse me, there is liability as I have told you, it is demonstrated here, get the present value. But also the standard says that subsequently the receipt should or must amortize the lease liability over the lease period to ascertain the lease liability payable in each year, both the current liability and the non-current lease liability. But to also subsequently depreciate the right of use asset over the lease period. If there is a condition in the lease agreement saying that the ownership of the asset will pass to the lessee at the end of the lease period, if that is the case, then the lessee should subsequently depreciate the right of use asset over the shorter of the lease period or the useful life of the asset. If that is the condition in the lease agreement. But if there is no condition saying that the ownership will pass to the lessee at the end of the lease period, then it means that the lessee will depreciate the right of use asset over the lease period. Now, we have a practical example we are going to deal with here, and it says that the lessee enters into a 5-year lease of a warehouse building. Lease payments are 200,000 per annum payable in arrears. The lessee incurs direct costs of 20,000 and lease incentive of 8,000. The lease contains neither a residual value guarantee nor a purchase option. The interest rate implicit in the lease is determined to be 6%. So now, how do you deal with that? Of course, if you are a student and you want to answer this, you first quote the standard. You say in a IFRS 16 leasing requires the lessee to initially recognize the lease liability by discounting the minimum lease payments using the interest rate implicit in the lease, but to also recognize the right of use asset that is obtained by aggregating the lease liability, direct and indirect costs, initial deposit, decommissioning costs, less any lease incentives. Then after you start doing that practically. So how do we start? We are going to start by discounting the minimum lease payments such that we can get the lease liability. As you can see here, we have future cash flows or future payments. Because the question is saying that the lease payments are 200,000 per annum. I have painted this in red such that we can see. So per annum, minimum lease payments are uniform here in this column. 200,000 in year 1, 200,000 in year 2, year 3, year 4, and year 5. Then you have this column of the discounting factor. You can get these discounting factors using the tables or using the calculator. The formula is here. Where R is the rate. The rate is 6% in this case. Then N is the number of years. However, there is a trick or a shortcut that one can use. If the cash flows or if the minimum lease payments are uniform, you can use the present value annuity factor. How do we get that? You get 1 minus 1 plus r to power negative n. You divide everything by r. So by doing that, in that case, n is 5 because we have 5 years here. So the annuity factor you'll get, you'll simply multiply it by 200,000 and you'll get 842 200,000, and that is the shortcut one could use. But now, since sometimes that's why you find that the cash flows are not uniform, you use the present value discounting factors. And now, when you apply the formula here in year 1, of course, you get n in year 1, n becomes 1. Then in year 2, n becomes 2. In year 3, n becomes 3. In year 4, n becomes 4. We are paying in arrears, and therefore we are going to consider all the years. If we are paying in advance, the payment for year 4, for year 5, would be now made in year 4 because we are paying before we enter the year. So the payment for year 1 is now paid before we enter the year. I think we get that. So now we are paying in arrears. What you do after getting the discounting factors, multiply them with the minimum lease payments to get the present values, the column that I have painted red. Multiply this by this to get this. So I code this discounted amounts such that it can be somehow clear. But literally, these are present values. Then after add them. So if you add them, you will get the total lease liability. Then the standard also requires the lessee to initially recognize the right of use asset. By aggregating, you can see the minimum, the lease liability is here, the one we just computed. Here is what you start with while computing the right of use asset. On that, you add the initial costs, the direct costs, the initial deposit, you add it back to the lease liability here. You add restoration costs, but restoration costs must also be discounted. Must be discounted because in most cases, decommissioning costs or dismantling costs are paid at the end of the what? At the end of the project. So we get the present value because that is a future value. Add it back also, but less any lease incentives. What you get is the cost of the right of use asset at initial recognition. Now, the standard, of course, as an accountant, you now have to pass journal entries. And if you have the right of use asset and there is liability, you simply need to debit the right of use asset with the figure obtained here. This one that I have painted purple. But credit there is liability with the figure also. The balance means that the initial deposit and maybe the direct costs were paid through bank or cash. So the balance is credited to bank or cash. Subsequently, the standard requires the lessee to amortize the lease liability such that we can see which liability is payable in year 1, which liability is payable in year 2, year 3, and year 4. Now, we create amortization schedule here. We have a column for years, a column for the opening balances, a column for interest, the column for minimum lease payments, and the column for closing balances. Now, of course, we shall start with the lease liability in total because in year one we haven't paid anything. We still have the full liability. Then we subject it to the interest. What is the interest on this liability? 6%, according to the question. The question said 6% here. Let me paint it now red or green such that you can see what I'm saying here. So now we are going to add back interest, and then after adding back interest, we raise the minimum lease payments because we are paying 200,000 every year. So if we get the liability, we add the interest. Why are we doing this? We are paying at the end of the year. Therefore, we must first charge interest before we pay the minimum lease payment. If it was paying in advance, we would first pay, and interest would be now charged to the balance. After paying 200,000, what remains? What remains is what you charge interest and then add it back to get the closing balance. But now, since we are paying in arrears, you get the opening, you add back interest, then you raise the minimum lease payments of 200,000 to get the closing balance. The closing balance of year one must be the opening balance of year two. Now, after getting now that, you also charge interest. After charging interest, you add it back to the opening balance and then raise the minimum lease payments of 200,000 to get the closing balance. The closing balance for year two becomes the opening balance for year three. Likewise to year four, likewise to year five. So you can see at the end of the year five, you have paid already. You don't have closing balance that must be brought forward in year six. So that is how you amortize, or that is how the minimum lease payments must be paid throughout the lease period. The standard also says or requires the lessee to subsequently measure the right of use asset by depreciating it over the lease period as we had earlier asserted. So now, if we can borrow the knowledge of IAS 16, property, plant, and equipment. IAS 16 is different from IFRS 16. So IAS 16 is PPE. We shall look at it later. But we can borrow the knowledge of depreciation, how to depreciate the assets, by getting the cost minus minus salvage, then divided by useful life of the asset. So if you can get the cost of right of use asset as 854,200, divide by the lease term, the lease period of 5 years, what we get is 170,840. That is depreciation per annum. No, so at the end of year one, to get the net book value, we get the cost minus depreciation for 1 year. And if you get that, you less this, automatically you get the carrying amount or the net book value that should appear in the balance sheet at the end of year one. Then for year 2, you can choose to do it this way, the way I did it here. You get the net book value for year, or the closing balance for year 1. Now becomes the opening balance for year 2. Then after you raise depreciation for a full year to get the figure here, which is net book value at the end of year 2. Or you can do it the other way around. You can say that for year 1, it is 854,200 minus 170,840,000. What you get is this. Then for year 2, it should be 854,200 minus 170,840 times 2 years. Automatically you get 512,520. Then for year 3, you do the same. You get 854,200 minus 170, 840,000 times the 3. What you get the net book value at the end of year 3. Likewise to year 4, and by the end of year 5, we no longer have the rights. The lease period was for 5 years, so it is depreciated to 0. Now, after that, of course, as an accountant, you have to report in the financial statements. Which figure goes to which financial statement? If you can start here, the assets are reported in the statement of financial position, the one we call the balance sheet, at their net book values. So at the end of year 1, the right of use asset will appear at its net book value of 683,360. Then at the end of year 2, the figure is here. The year 3, the figure is here. And it must appear on the face immediately after reporting property, plant, and equipment. Report the right of use asset. That is done. But also depreciation. The column for depreciation is here in purple. Let me borrow it such that we can get it right. Depreciation is an expense and therefore it must be reported in the income statement. And so depending on the depreciation policy or the policy of reporting, some companies can report it as an administrative expense. So administration expense, you add it back. Or some can charge it to cost of sales, depending. So this one, or you can just present it as an independent line item in the income statement under expenses. So year 1, year 2, year 3, the figure is the same. What else do you report? Of course, you report the liability. And the liability, there is liability for year 1 is 692732. But this liability is split into current liability and non-current liability, because there is that portion of the liability that cannot be settled within a period of 1 year. That portion is referred to as non-current liability. So the current liability for year 1, you simply get 692,732 minus the total liability for year 2. The difference is what is payable in a period of 1 year. The non-current liability for year 1 becomes the total liability for year 2. That is how we should report it. Then when you go to year 2, the total liability is 534,296. The current liability is the difference between the liability for year 2 and the total liability for year 3. Then the non-current liability now becomes the total liability for year 3. So you do the same to year 4 and year 5. Of course, for year 5, the liability is nil. So that is how we report. But also, we have interest. And interest is a finance cost. It must appear in the income statement as an expense immediately after reporting the operating profit. What follows is the finance cost or the interest expense. And now for year 1, it is 50532. For year 2, it is 41564. And for year 3, it is 32058. So report the way they are here because they are direct. The fourth item to report is the minimum lease payments as cash outflows towards financing activities in the statement of cash flows. So you report 200,000 for year 1, 200,000 for year 2, do the same for year 3, do the same for year 4 and for year 5. So that is what we can discuss today. This is IFRS Scene Part 1. In the next session, we shall look at how we can deal with the scenarios where minimum lease payments are payable in advance. But also we shall look at sale and leaseback. In instances where the lessor or the legal owner sells the asset and then leases it back, what happens? We shall look at all those scenarios in the next session. But today, this is where we can stop. Thanks for being with us. I empower you members and I request that you subscribe. But also hit the like button such that we can understand these accounting concepts and standards together. Thanks for watching. God bless you.